Hello and welcome back. In this lecture then, we're going to carry on looking at what happens for companies that are in financial difficulty. So first of all, receivership. This is not the same as administration. I know we use the word administrator here. Administrative receivership is where a floating charge holder takes control of the company's properties. A fixed charge receiver is where a fixed charge holder takes steps to enforce his security. Now, a fixed charge receiver is different to all the other receivers we've looked at because he doesn't have to be a qualified insolvency practitioner. Indeed, he's quite often a property specialist because the most common asset subject to a fixed charge is land and buildings. And his job is to try and realise the value of the property. Now, he doesn't have to do anything extensive to try and improve the value of the property or anything like that. He just has to act sensibly, and once he's sold the property, if he's recovered surplus funds, he'll pay those over to the company. If he hasn't, then his client will become an unsecured creditor for the balance. It's worth mentioning the appointment of a receiver does usually trigger a floating charge, so that will also crystallise at that point. I'd also like to briefly mention CVAs. These are relatively new. They came in 1986. And these can either be alongside or administration, so they can be the outcome of an administration order, or they can be standalone. And the idea of this is that the company will reach an agreement with its creditors as to will allow the company to survive. So again, we're talking about companies that are sick, not necessarily terminal. Things you might do, you might agree to pay everybody a certain rate in the pound and they'll write their debt off in return. You might just agree instalments, a longer time period of repayment, or convert your debt to equity. Short-term debt converted to long-term equity, that's got to give the business time to recover. Now, the way you do this is you appoint a nominee who can help you through the process. Now, if you're already in administration, it's probably going to be your administrator. And if you're in administration, you will already have a moratorium on actions being brought against you. If this is a standalone process, you can apply to the court for a 28-day moratorium to give you time to get your act together. The nominee will consult with your creditors and so on, put together a proposal and report to the court. If his advice is that we should go ahead with this, the court will normally approve it. It's then put to a formal meeting of creditors and shareholders, and once it's approved, it becomes binding on all unsecured creditors, but not fixed charge holders. Okay, I want us to look at liquidation now, and this diagram is quite useful. So liquidation is where a company is officially wound up. Because it is a separate legal entity, you can't just stop having a company, you have to go through a fairly specific process. Now, you'll see there are two types of liquidation there, voluntary liquidation and compulsory liquidation. Oh, that extra line's about. And voluntary liquidation has two subheadings, members liquidation and creditors liquidation. Now, it's really important people get confused here. Because this one's got the word creditors in it, it doesn't mean that creditors instigate the process. This process is always created by the company, either by its directors instigating it or by its shareholders. However, a slightly different procedure has to be followed depending on whether the company is solvent or not, i.e. can it pay all its debts. And the reason for that, if a company is solvent, it's really nothing to do with the creditors, whether the company goes ahead or not, because the company will be wound up, the creditors will get all their money, then have no say in the matter. However, if the company isn't going to pay everybody in full, the creditors have a say in how that company is wound up, and they'll have to approve the plans for doing that. So let's have a look at the two procedures. You'll see they are kind of similar. So a member's winding up, your company needs to be solvent. And to do that, the directors give a declaration of solvency. And we'll look at that in more detail in a moment. So we start with a special resolution of the company, of the shareholders. Get the declaration of solvency, and we have to advertise in this thing called the London Gazette. This is the place where we advertise anything that we want to have given legal notice of. I'm sure it's not very widely read, but certainly legal databases and legal entities will check notices that are in the London Gazette. The company will then appoint its own liquidator, so an insolvency practitioner, again by special resolution. And he will arrange for the company to be wound up. Once he's done that, he'll prepare final accounts. They're approved by the shareholders, and then finally he has a week from the date of approval to file those accounts with the company registrar, and he'll wait 3 months and then dissolve the company. That 3 months is just in case anything else comes out of the woodwork. In terms of the creditors winding up, it's a slightly more complicated process because this applies where we can't make that declaration of solvency. So we have a shareholders resolution to start the process, and we can appoint our liquidator. However, this appointment is only provisional. It won't be formal until we've had a creditors meeting and the creditors have confirmed that appointment. So the directors have 14 days to call a meeting, and they have to give 7 days notice to the creditors. And when they tell the creditors, they have to give them certain information. For instance, obviously where the meeting will be and so on, but also where they can see a list of the company's creditors. Because, if you're owed money by this business, you're going to want to know how bad things are, and you're going to want to know whether it's worth you turning up at this meeting. So the meeting will go ahead. And at this meetings, the directors present a statement of affairs, so a detailed statement again of how bad things are for the company. And if the creditors approve the director's choice of liquidator, that's great. If not, they can override the company's choice. Once that happens, the creditor gets full powers. The insolvency practitioner gets his full powers. He goes ahead and prepares his final accounts. They're approved by the creditors and the shareholders, and then, as before, he files them with the company registrar. Now, key difference between these two procedures, going too far there. A key difference between the creditors and the members winding up is this role of the creditors. And to help the creditors be involved in this process, we form something called the liquidation committee. And that's made up of representatives from the shareholders and also from the creditors, and they will consult with the liquidator and help to come up with a plan for the insolvency of this company. Now, a couple of admin points here. The interim liquidator, this is the one that's appointed in a creditors winding up by the directors or the shareholders before the creditors meeting. Now, there have been cases where directors have appointed a friendly liquidator who has sold the company's assets to a company owned by the directors at a pretty reduced rate, so that by the time the creditors have their meeting, the company's assets are long gone and there's nothing left for the creditors to fight over. So what happens is now we have this, that process came from a case called centre binding. And to prevent centre binding, we now say that the liquidator has limited powers pending the confirmation of his appointment by the creditors. So these are the 3 things he's able to do. He can take control of the company's property. He can deal with perishable items. There's no point preserving those for the creditor if they've already gone rotten. And he can do things to protect the company's assets. But that's it. And that should ensure that there are some assets there for the creditors by the date of the meeting. I also mentioned the declaration of solvency. Remember this statement that the directors give? We've seen this a few times now throughout the lectures. And I've said it's very important that the directors are very careful about giving this. So they are effectively saying that the company will be able to pay its debts in full, together with interest within a specified period, and that's normally 12 months. Now, as I've mentioned earlier, it's a criminal offence, possibly fraud, to give a false statement of declaration of solvency. So you've got to be careful. Who makes it? Well, it's all the directors, or if you've got more than 2, a majority of them. Gives details of the company's assets, supported usually by an auditor's statement as well. There's time limits because obviously it's got to be current. So you do it within 5 weeks of the resolution to wind up the company, and you file it with the registrar within 15 days. Okay, so again, just be aware of that. I've seen odd questions about the declaration of solvency. Now, you will remember from my diagram, let's just go back to it, that there is also this heading here of compulsory liquidation. Now, this can be for a solvent or an insolvent company, but it's where the shareholders aren't in agreement about this. Somebody is actually forcing the company to go through a liquidation process. Now, to do this, you're going to have to involve the court. It's going to be expensive, it's going to be time-consuming, so it doesn't happen that often. Now, the Insolvency Act has 7 grounds for winding up, but we're only worried about 2 for your exam. The first one is that the company is unable to pay its debts. And the creditor has to show, and this is the most common one for the exam, he's got to be owed more than £750, and he's got to show that he served a demand on the company. You know, it's a formal, official, legal letter saying, I must be paid within 21 days. So he files his demand, waits 21 days. If he still hasn't been paid, he can go to court and have the company wound up. Also, a judgment creditor. A judgment creditor is somebody who has taken legal action against the company in the past, has a court order saying that he's owed money, but hasn't managed to enforce it. And then the final one is what we sometimes call the balance sheet test. Basically, a creditor who can show that the company is unable to meet its liabilities. And that's just a question of fact. Another ground we might look at, and we've seen this before, we saw it in the Ebrahimi case. You could show that it's just equitable to wind up the company. And usually this is just one shareholder who finds himself a little disaffected with his company. And again, Ebrahimi was a good example there. We had a quasi-partnership, 2 people running a business together, and one of them was excluded from running the business. And the court agreed that it was just equitable to wind the company up in that situation. However, remember, the court will only make an order on these grounds if it's a last resort. The Department for Business, Innovation and Skills, they are able to wind up a company also. And basically 2 reasons. If it's a public company which hasn't got a trading certificate within 1 year of incorporation, or following a report into a company that says it's in the public interest to wind the company up. Now, when there is a compulsory winding up, there is usually an investigation, and the official receiver is appointed to look into the causes of failure for the company. So he's not necessarily concerned with how the company's wound up, he just wants to make sure that we understand why the company failed and decide whether any action needs to be taken, for instance, for fraudulent or wrongful trading. Okay, so if an order for compulsory winding up is made, what happens? Well, slightly strangely, I always find, the liquidation is deemed to have started when the petition was first presented, and that can be quite a while earlier. It's not easy to get court time. So from the date the presentation was filed at the court, any transfer of a company's property or a sale of shares is void unless it's been sanctioned by the court. A bit like with administration, legal proceedings are halted, seizure of assets is halted. In this case, the employees are dismissed because, unlike administration, where we were trying to preserve the company, in this case, we're just trying to wind it up. Floating charges will crystallise. Now, although the assets stay in the company's name, the legal entitlement, it's the liquidator now who's got control. The directors have all been sacked, and it's his job to try and realise all the assets. But remember, in this case, the emphasis has switched. The liquidator is focusing now on getting the money in. Now, if that means continuing the business gives him a slightly better result, he'll do that, but only with a view to realising those profits. Have a quick look at question 19, see what you think. So this is Zorro Limited. See if you can answer the questions and then compare your answer to mine. Okay, so my answer would be yes, he can, because he's owed more than £750 and he's issued a demand asking for payment and he's waited more than 21 days. So he can certainly do that. It's quite drastic, but it's an option. Can he appoint an administrator? Well, he can, but only via the court route, because he's only a creditor, he's not a qualifying floating charge holder. So he'll have to go through that slightly more expensive and cumbersome process. Now you've concentrated really hard, so I think you've earned a tea break there. So we'll stop this recording here and we'll come back and have a look at the powers of the liquidator in a separate lecture shortly, and I'll see you then.